Today, we intend to explain the top candlestick patterns to you which every trader needs to predict trends and find the best entry and exit points. We will explain how to use these candlesticks to maximize your profits and increase your win rate. Before I explain these candles to you, please subscribe to the channel and be sure to like this video if you find it helpful and leave your feedback in the comments. Now, let's get into the explanations. First of all, you need to know that price candles are made of three parts. The first part, body. The second part, close and open prices. And the third part, shadows that indicate the highest and the lowest prices. When you look at the chart, you may think that these candles and their shapes are insignificant. But in reality, the shapes of these candles carry explanations with them. If you can understand and interpret them correctly, trading will become much easier for you because you will know what is likely to happen. In fact, the way candles open and close indicates the strength of buyers and sellers. If you can identify them correctly, you can be very profitable in your trades and find very good entry points for entering a trade. Now, let's talk about the first candle called Tweezer. You can see two types of candles in the pictures. These candles appear when buyers or sellers lose control of the market. This candle pattern can consist of two or more candles, and we need to pay attention to these critical points when we see these types of candles. The appearance of these candles at these points can be sign of a trend change, like these points that we observe a trend change. For example, here you see a strong downtrend, but when the price reaches this important level, it refrains from further decline. At this point, buyer pressure increases because there were many lower shadows indicating attempts to lower the price but failed. Sellers try to bring the price down, but after several unsuccessful attempts to reduce the price, the market starts producing these types of candles, changing the trend to an uptrend. Buyer strength increases compared to sellers, and the price starts to rise. The next candle we will talk about is called Dogee candle, like the one you see in this image. When you see this pattern, you should know that it doesn't indicate an uptrend or a downtrend. When this candle appears, it means that buyer or seller strengths are equal, and the price may enter a range without any changes. So, you should be cautious and understand that when you see these types of candles, the trend you are in may have ended, and the market may want to appear in a range. These candles always have long shadows and very small bodies. These candles can be either bullish and green or bearish and red. However, what is essential for us is that the close and open prices of these candles are usually very close to each other or sometimes even the same. Regardless of their formation, this pattern can help us a lot, especially in places where candles encounter support or resistance levels or trend lines. After such encounters, this pattern can be very helpful in determining the next trend. For example, here we see a very strong uptrend where buyer power was much higher than sellers. However, gradually the candles weakened until this pattern appeared here. The presence of this type of candle means that this point is crucial for decision making in the market. Buyers and sellers are confused about continuing the trend, and buyers are struggling to push the price higher while sellers are struggling to bring it down. After seeing the Dogee candle, the price can go in any direction. But with the next candle, you can decide whether to place a buy or sell order. The third pattern that we are going to learn is the engulfing pattern, and you can see its images. This pattern indicates the end of an upward or downward trend. The ideal time to form this candle is when the open of the candle is lower than the open of the previous candle and the close is higher than the close of the two previous candles. Of course, in transforming a downtrend into an uptrend, when we see this pattern, we can decide that our trend has ended and we are in the process of changing the trend from downtrend to uptrend. For example, here on the chart, you can see that the price has started to reverse multiple times at this point, forming a strong support level here. Buyers have a strong interest in buying at this point, and after several price reversals, you can see this pattern here clearly, which is larger than the two previous candles. You can enter a trade here, set your stop loss below the support line, and achieve good profits. The psychology behind these types of candles is that buyers have completely overwhelmed sellers with a sudden influx into the market at these points, indicating the start of a strong and powerful trend for us. The most important thing to remember about identifying these candles is that you should remember that these types of candles always form in the opposite direction of the trend and are usually much larger than the two previous candles. Finally, make sure to remember these patterns and practice them on a chart so that you can develop sufficient skills in recognizing these types of candlesticks. Don't underestimate practicing so that you can quickly identify these candlesticks on a chart and become a profitable and skilled trader. Goodbye until the next video.